Welcome to Empowered. I'm Elizabeth Naumovski. Personal debt has been the topic of discussion during the first quarter of 2024. Consumer debt is at $21,131, and the average credit card balance for Canadians is $4,265. To tell us why personal debt is rising and why it's important to deal with your debt now, I'm joined by Laurie Campbell of Doyle Salewski Inc. Laurie, welcome. Welcome to Empowered.
Oh, thanks so much, Liz. Happy to be here.
So let's begin. Why is personal debt rising so fast?
Well, it's interesting because Equifax put out a report. I just think it just came out off the wire today that said the two reasons that debt has increased so much and why it's such a problem is one, obviously inflation, and the other one is interest rates going up. And so what their study stated was that in the last quarter of 2023, mortgage delinquencies, this is shocking, have gone up by 52%. Shocking to me. And the other big number is that credit card delinquencies, it's not about debt, it's about delinquencies, has gone up 30% in the last quarter of 2023. So what that tells us, Liz, is that this is becoming a huge problem for Canadians. This is now an everyday problem for many, many Canadians across the country.
I don't like to hear that. I want to hear that Canadians are prospering, and this is not good news right now. This is bad news. But what are you hearing from your clients?
Well, the biggest thing I'm hearing on a daily basis, and what we're hearing at Doyle Salewski daily, is that people are having a hard time simply putting food on the table. Every person that we speak to speaks about the fact that, groceries, it's food insecurity. We are dealing with food insecurity in Canada. Many of our clients are going to food banks because they can't put food on the table. The second biggest problem we're seeing is not just those individuals whose mortgages are coming up for renewal, but those individuals who are renting. Because, let's face it, in the major urban centers across the country, we're looking at $2,000 plus for a one-bedroom apartment. Now, incomes have not kept up with this. And the result is that many people are struggling just to make ends meet for their necessities in life. Nothing frivolous here, Liz. Necessities.
Yeah, so I want to talk about debt. What type of debt is the greatest concern right now?
Well, there's a couple. I'd say there's two for sure. And one of them obviously is payday loans. We know that the interest rates on payday loans are huge. The fact that you have to pay them back in 2 weeks after you get them because they're due on payday is a big problem for individuals that are borrowing them to, make their rent or just, as we talk about, put food on the table. The other big problem is credit card debt. And the reason that these two are my two enemies when it comes to personal debt is obviously because payday loans have a huge interest rate and you have to pay them back so quickly, and credit card debt interest rates are anywhere between 19.9% and 29.9% for retail cards. So those two factors are causing havoc for Canadian wallets and Canadian financial situations.
I want to talk a little bit about payday loans because a lot of people don't understand how they work. Can you explain them to us, please?
Well, in a nutshell, you'll see them everywhere. Different payday loan companies, I won't mention the names, but you've probably seen them on a lot of street corners. What you do is you may go in and say, look, I don't get paid until next Friday. Today's Monday, and I don't get paid until the following Friday. I need to make my rent because rent's due tomorrow. I need to get a payday loan. And so what you'll get is a payday loan for the amount that you ask for within their limits and parameters, and then it's due back that next Friday. Now, there's some limitations on what they can charge, but if you amortize that over a year, these charges are upwards of hundreds, like 100+% interest rates. So you can see how people that get into the cycle of payday loan borrowing have a hard time getting out of it. Now, there are some stipulations in provinces that say you can only borrow one or two payday loans within have two on the go at the same time, for example. But unfortunately, many payday loans don't report to the credit bureau, so it's very hard to track these for lenders that may give out that third one.
Okay, so we're just getting ready to go to commercial break. But when we come back, Laurie, I think what I'd like to do is delve a little bit more about compounded interest, because there's a huge generation right now that doesn't understand that if you don't pay your credit card off completely, you will be charged a compounded interest. And people don't understand exactly what that is and what the impact is on, how much you pay and how much you owe. So if we can delve into that when we come back from commercial break, that would be great. So please don't go away. We'll be right back. Welcome back to Empowered. I'm Elizabeth Naumovski. Today, we are discussing the rising household debt in Canada. Laurie, before we went to break, I was talking about compounded interest. Can you just please take a couple of minutes or whatever it is to explain it? Because there's a whole new generation out there that doesn't understand it. And they think if they just put it on their credit card and just pay the minimum, they're going to be okay.
Well, there's a couple things that people need to be wary of, and we talk about compound interest. But let's take an example. I think it's always good to have an example. So let's say you go out and you buy something for $1,000. Let's call it an even thousand, and you pay $400 off when the balance comes due. You know you're paying more than the minimum balance. You're feeling pretty good about that. Well, guess what? You're being charged interest on $1,000. So keep that in mind when you're using those credit cards. If you're not paying it off in full, you're paying interest on the full amount that is on that balance for that month. The next month comes along, and guess what? You're now paying interest not only on the $1,000 that you originally were paying interest on. If you only pay a little bit off the next month, now you're paying interest on the interest that you're being charged. So if it's 20% interest over, like annualized over a year, let's just say that, for example, break that down, a certain percentage of that interest is going to be charged in that month. The next month comes along and you're going to be charged interest not only on your new purchases, but on the balance that you had before if you're not paying it off, and then interest on the interest that is already being charged. And that's how it compounds over time. And a lot of people will think, oh, but I paid, $785, $1,000. I've done really well. Yes, you have, but you're still being charged interest on that full $1,000. It's a killer. And so many people don't realize that's how the banks are making their money. And that's how you, as a consumer, are really getting yourself into a rut of never getting out of that battle. And then you add that over many, many years. And so that outfit that you bought for $200, you've now paid for it 5 times because you have never paid that balance off in full. And you may only be paying the minimum, thinking that that's all they asked me to pay. I'm paying what they asked. I'm doing what I'm supposed to do.
You know what's important too? A lot of people don't look at their statements, and for, let's say, $1,000 purchase, on that statement, it says that it will take you almost 8 years to pay it off if you only pay the minimum. So we really need to look at those statements and read them and understand exactly what they are.
Yeah, and look at the fine print too, Liz, because it's not saying in bold letters right beside, your balance and what you have to pay, how long it's going to take you to pay it off. It's usually on the next page in fine print. And, and we talk about young people today, so well educated. We know we've got a very well educated population amongst our younger individuals that are just starting out, graduating from university or college. And the average person doesn't realize that just paying the minimum balance doesn't mean that you're doing the right thing. It just means that you're doing what the bank's asking you to. Always pay it off in full.
And that's so important.
Yeah, it's so important. If you can't, take a look at your financial situation. Put your credit cards away. Do what you need to do to get out of that situation, because what'll happen is you'll have 5 cards eventually with the same problem.
So, Laurie, how has credit reliance changed over the past 40 years?
Well, I'll give you an example, Liz. Back in 1990, the debt to income ratio was for every dollar a Canadian made, they owed 90 cents. Okay, so sound pretty good. You make $1, you only owe 90 cents. Today, for every dollar a Canadian makes, they owe approximately $1.82. So it's doubled. It's actually doubled the amount of outstanding debt that we have. So we've become uber reliant, not only on credit cards, but also on, lines of credit. We've been relying on our overdraft. We've been reliant on, we talked about payday loans. We've been relying on continuing to cash in on the equity of our home. So people aren't getting anywhere, and we're really struggling and becoming cash poor as a society. Add interest rate increases on there, and it's a combustible situation.
And I think that one of the problems is we had a whole generation that was living through a low interest rate period. And nobody ever thought that interest rates would start to go up. So they started buying properties and started borrowing money. And all of a sudden now, with interest rates going up, people are realizing that they can't afford the mortgages that they were paying before because they've changed so much. And they can't afford the loans that they have because the interest rates have gone up and they didn't lock in on it. So when we come back, I want to talk to you about, I want to delve in on what are the highest interest rate credit vehicles out there that, we should look out for and maybe stay away from. So don't go away. When we come back, we're going to talk about interest rate credit vehicles. Welcome to Empowered. I'm Elizabeth Naumovski. Today, we're discussing rising household debt in Canada. Laurie, before we went to break, I was talking about this, and I think it's really important. What are the highest interest credit vehicles right now?
Well, we already talked about payday loans, by far the highest. And then we've got finance companies that charge upwards 30, 33, 34%. That's a very high product as well. People always forget about overdraft. Overdraft, Liz, is a killer. It's like 21%. It's like, don't go into overdraft. The other one that we, fail to remember is borrowing on your credit card. So cash advances on your credit card. First of all, the interest starts from the date that you get that cash advance. You get the cash advance today, there's no grace period, there's no moratorium, the interest starts immediately. So remember that. We also have situations where people go and buy a vehicle, and because they have poor credit, they're high risk. And because they're high risk, the interest rate that car company is going to charge you, or dealership is going to charge you, is much higher than other people who have better credit scores and credit ratings. So, these things all need to be kept in mind, because once your credit score starts to tank, it takes a long time to rebuild it. So that's a really important factor. Really think carefully about how you're using those credit cards and how it's going to impact you over time.
So we're going to talk about credit scores coming up, but I want to talk about financing a car right now, because apparently it's changed in the last decade, and it's changed quite a bit.
Right. Okay, so financing a car, well, first of all, changed. It's ridiculous how long you can finance a car over 7 years now, Liz. It's just like, a lot of cars don't last 7 years. So that by the time you're finished making that last payment, the warranties run out. All the shiny new pieces are kind of like rusting, and you may have a lot of kilometers on it. You're not going to get your resale value. So what do? You go out and buy another shiny new car for another 7 years of payments. So that's a big factor. It used to be 5 years. You had to pay it off in 5 years, and that's the limit. The other factor is that people are now buying high-end vehicles. I often see people paying $700, $800, $900 a month just in their car loan or their car payment. Now, Liz, let's add in insurance, costing more on high-end vehicles. We've got maintenance. Obviously, you can't get away from that, or your car is going to fall apart. And the other thing is the high price of gas. The high price of gas right now. So, the bigger the vehicle, the more it burns gas, the more expensive it usually is, and the higher the cost. So people need to really think about these things when they purchase a vehicle. Look at all these factors. If you can pay it off in a shorter period of time, do it.
And I think it's really important. I mean, I'm a firm believer of not having debt. Pay it off as quickly as you can. What are steps people can take to deal with their debt right now?
Well, first of all, do a tally. Find out where you're at today. Like, who do you owe? Who's the highest interest debtors, creditors that you have? Get rid of those ones first. Sit down with your family members, your spouse, your partner. Talk about how you're going to make a plan. Get a budget going. Figure out how you're going to start knocking off some of this debt. Make sure that you always at least make your minimum payment. You don't want to start getting into delinquencies and arrears. Very hard to catch up. And of course, Liz, if those things fail, get expert help. And when I say expert help, Liz, I'm talking about legitimate trustee in bankruptcy, legitimate licensed insolvency practitioners, so that you're not going to some place online where they charge you a whole bunch of money and then send you over to somebody else who really can't help you.
And that's really important. Some people think, well, I'll just claim bankruptcy, but there's also a consumer proposal. What's the difference between a consumer proposal and a bankruptcy?
Well, a number of differences. First of all, with a bankruptcy, what you're saying is, I'm not going to be able to pay this debt anytime in the future, in a reasonable period of time. nor do I have any assets that I can sell to repay this debt. I have nothing except debt. So that's when a bankruptcy might be more reasonable, and your income is, not over a certain threshold. Consumer proposal is where you're saying you're making an offer to the creditors. I can pay you a certain percentage of the debt, it might be 25%, whatever the case may be, and my assets don't outweigh the promise that I want to that I'm going to repay you, and my income's within a certain surplus amount. And you know what? I really don't have any other means of tackling this debt. So it is a voluntary process as well. However, there are different restrictions on it. Now, with a consumer proposal,
Laurie, hold that
yes,
thought. We're going to continue with consumer proposals when we come back. Welcome back to Empowered. I'm Elizabeth Naumovski. I'm joined by Laurie Campbell, and we're discussing the rising household debt in Canada. Laurie, my apologies. You were talking about consumer proposals.
Yeah, so a consumer proposal is basically saying to the creditors, I want to pay you back something, but I can't pay you back at all. And there are some regulations and rules. It's a great product for individuals that are just not making ends meet, but know that they want to be able to pay back something, and they have the means to pay back something. So a good opportunity for someone struggling that may not want to look at a full bankruptcy.
I want to focus on credit scores right now. So how does a credit score work?
Well, it's quite simple, really. Okay, so Liz, if you think about a credit score as a continuum, so 300 to 900, okay? 300 being a very bad credit score and 900 being like the best credit score ever. And so you want to be closer to 900 with your credit score and get there through repaying your debt on time, having a good stable income, little things like not having a bunch of open credit, such as 10 different credit cards. That'll lower your score. Making sure that you've been in your place of residence for a while, making sure that you're not out searching for credit on a regular basis. And what I mean by that, Liz, is a lot of people say, you know what, I want to see if I can get a credit card from bank number 1. Well, let me try and get one from bank number 2 and bank number 3 and bank number 4. Well, all of those 4 banks are going to be looking at your credit to find out how you've been managing. And they're going to also put a trade line there that shows they've been looking at your credit. So bank number 5 is going to say, hey, wait a minute, why are the other 4 banks looking at her credit? Maybe there's something, is she fishing for credit? Is she trying to accumulate a bunch of credit? It doesn't look good. So little things like that can really impact your score overall.
So for somebody who's struggling right now with their debt and their credit score, how can they maintain a good credit score?
Well, number 1, pay your minimum payment. That's going to be very important, because every time you miss a payment, it's going to show some sort of delinquency on your credit rating, which will impact your credit score. Okay, that's number 1. Try to bring down your debt. That's going to be imperative, because what we look at is the amount of debt outstanding, and that helps build the credit score. Limit the number of credit cards you have on your credit file. So don't start opening up more to deal with the debt that you have, because what that'll show is your availability to get yourself in financial difficulty goes up, because now you have 5 credit cards you can get yourself into difficulty with rather than 2 or whatever number you have. So don't try to, it's kind of like chasing a bad situation. Don't chase your financial situation by getting more credit out to pay off your first bit of credit. That's when you know you need help. So that's imperative. If you have a change in address or a change in situation, make sure your information is updated at the Bureau, and check your information on a regular basis. You don't know if there's been fraudulent activity on there. There might be some misrepresentation or misreporting on there, and you want to catch that quickly. You certainly want to catch that before you try to borrow anything further.
So you were talking about checking, looking at it. Can you get credit with bad credit scores?
It's not impossible, Liz. It's not impossible. Like, people are going through a consumer proposal because they've dealt with their financial situation and they've got a regulated plan. Sometimes can get a credit card. It might be a secured card, but it's a good way to start to rebuild your credit. But the truth of the matter is, if you've got bad credit and outstanding debt, deal with that first. Make that priority number one. And when I talk about, people trying to get credit to deal with other credits, usually when they're up to date and they're like, well, you know what, I can't use that card anymore because it's maxed out. Let me go get another card. That's never a good plan of action. It may your credit score might not look terrible, but over time, it's not going to help your situation at all.
Laurie, thank you so much. I know there was a lot to unpack into this show today. It's a lot of information, but I know that this information that you shared with us will help a lot of people out there that are struggling with debt or struggling with their credit scores. So thank you so much for being on Empowered.
Always a pleasure. Thank you for having me, Liz. My pleasure.
Money is emotional to most and can cause extreme stress that can hurt your emotional well-being. I've heard people say, if I only made more money, I wouldn't have money problems. Sadly, that's not true. Don't let money control you. Start living in needs versus a wants life, and don't spend more than you make. But it sounds simple, but it's not. I'm Elizabeth Naumovski, and I'm here to empower you and make frugality fashionable. Thank you so much for watching. I hope that you learned a lot today. Bye for now.